I've been in this business for nearly 40 years now. I started BlackRock back in 1988 with a small team, focused on one big idea: helping investors manage risk better. We built something called Aladdin, a risk management system that changed how institutions saw their portfolios. Fast forward to today, we manage trillions for clients around the world, from pension funds and governments to individual savers building their retirement. Every day I talk to CEOs, world leaders, and everyday investors trying to secure their future. And you know what stands out most right now? People are anxious, more anxious about the economy than I've heard in recent memory. Inflation, interest rates, geopolitical tensions, there's always something to worry about. I get it. But here's what I've learned over 4 decades. We've lived through moments like this before. Crises come and go, the dot-com bust. 2008, the pandemic hand. Somehow, we adapt. Humans innovate, economies grow, and the capital markets. They've been the greatest wealth-building engine in history. That's what I want to talk about today. The timeless principles that separate successful long-term investors from everyone else. These aren't flashy secrets or hot tips. They're simple, proven rules that have worked through every market cycle I've seen. And in a world full of noise, these principles cut through it all. Let's start with the most important one. Think in decades, not days. It sounds basic, but it's the rule most investors break. Everyone I talk to is worried about what's next: tariffs, elections, AI disruption. And yes, those matter. But zoom out. The first real stock exchange opened over 400 years ago. Ordinary people could own shares in global ventures for the first time. Through wars, depressions, and pandemics, that system has delivered compounding growth like nothing else. If you de-invested in the broad U.S. stock market in the 1920s and just held on through everything, your money grew at about 10% annually on average. $1 turned into thousands. It's the power of long-term thinking. But most people don't do that. They check their accounts daily. They see red and panic, selling low. Then markets recover, and they miss the rebound. We saw it in 2008. Markets halved, people sold, and 5 years later, we hit new highs. We saw it again in 2020. A 34% drop in weeks, followed by all-time highs just months later. So how do you actually live this rule? First, stop checking your portfolio constantly. Studies show the more you look, the worse your returns, because fear leads to bad decisions. Check quarterly at most. Second, have a plan and stick to it. Know why you own what you own. If it's a quality business, a 20% drop doesn't change its long-term prospects. Third, automate your investments. Dollar cost averaging, investing the same amount regularly, removes emotion and forces discipline. If you're in your 20s, 30s, or even 40s, time is your greatest asset. The trajectory is up, driven by human progress. Now, Rule 2. Ownership is the foundation of wealth. Real wealth doesn't just come from a salary or savings. It comes from owning assets that grow and produce income over time: stocks, real estate, businesses. Today, about 60% of American households own stocks, which is great progress. But too many are just renting growth instead of owning it. When you buy a stock, you're buying a piece of a business. If that business innovates and increases profits, your ownership grows in value. Now, most people shouldn't be picking individual stocks. It's too risky. Instead, own the market through low-cost index funds. Own thousands of companies. Own the world's growth engine. But the future of ownership is bigger than just public stocks. Private markets like infrastructure and private credit are where institutions have earned extra returns for years. Pensions often allocate 20 to 30% there, and it makes a real difference. We're working to bring that to everyone, so everyday investors can own pieces of data centers, renewable energy projects, and the infrastructure powering tomorrow. Start owning. Even if it's small, own assets that compound, not cash that loses to inflation. Rule 3. Diversification is your best protection. I don't just mean owning a bunch of random stocks. True diversification spreads risk across assets that behave differently. The old 60-40 portfolio, 60% stocks, 40% bonds, worked for generations. But in 2022, both fell together. So, we have to evolve. Think more like 50% stocks, 30% bonds, and 20% in alternatives like infrastructure. These can provide steady income from things like toll roads or power grids, even during a market crash. Diversify across geographies, sectors, and time horizons. It won't eliminate volatility markets go down, but it prevents disaster. If you're wrong on one bet, the rest can carry you. Rule 4 is simple but huge. Costs eat your returns, so minimize them relentlessly. This isn't exciting, but it's critical. Paying 1% in fees instead of 0.05%? Over 30 years, that can cost you hundreds of thousands of dollars. We've driven costs down for decades with ETFs that cost just pennies on the dollar. Avoid frequent trading commissions and taxes add up fast. Studies show active traders often underperform a simple buy and hold strategy. Choose low cost, broad funds, and let your money work for you. Finally, Rule 5, stay humble and keep learning. Markets evolve. New technologies and new risks appear. I've been wrong plenty of times. I've dismissed things early, only to adapt later. The key is to read, listen to opposing views, and admit when you've made a mistake. Curiosity keeps you ahead. Things like AI, tokenization, and private markets are transforming investing right now. Stay open to them. These 5 rules, think long-term, own assets, diversify, cut costs, and stay humble, have guided us through everything. They're rooted in how markets actually work. Investing isn't about getting rich quick or beating everyone else every single year. It's about the disciplined ownership of human progress. It's about funding the innovation that improves lives and sharing in the rewards. For 400 years, markets have lifted ordinary people. Today, more than ever, that opportunity is expanding. Commit to these principles. Be patient. And start now. Your future self will thank you. Rule number 3 is one that saves more investors than almost any other. Diversification is your best protection. For decades, the standard advice was simple. 60% stocks, 40% bonds. It worked beautifully for a long time. When stocks fell, bonds often rose or held steady. Negative correlation, balance, safety. But 2022 changed the conversation. Inflation surged, interest rates rose fast, and both stocks and bonds dropped together hard. The classic 60-40 portfolio had one of its worst years ever. Clients called me worried. Institutions re-examined everything. That's when we started talking more openly about a new model. Something like 50, 30, 20, 50% in stocks for growth, 30% in bonds for income and stability, and 20% in alternative assets infrastructure, private credit, real estate. Why? Because these alternatives often move independently of public markets. Think about it. A data center lease doesn't crash when the stock market panics. A toll road still collects fees during a recession. A diversified power grid keeps generating cash flow whether tech stocks are booming or tanking. These assets provide steady, predictable income and lower correlation to daily market swings. At BlackRock, we've been building this out aggressively. We acquired Global Infrastructure Partners, one of the largest infrastructure platforms in the world. We bought HPS for private credit expertise. We're recreating products that let everyday investors access these same asset classes that pension funds and endowments have used for years to deliver smoother returns. You don't need to go full institutional right away. Start simple. Diversify across asset classes, stocks, bonds, some real assets. Geographies. Us developed international emerging markets and sectors. Tech, healthcare, consumer staples, energy, financials, everything. And also across time horizons. Some cash for emergencies, the rest long-term. Broad low-cost index funds give you most of this instantly. One S&P 500 ETF. That's 500 companies across every sector. Add an international fund and a bond fund, boom. Global diversification in just 3 holdings. The goal isn't to eliminate volatility. Markets will always fluctuate. The goal is to prevent catastrophic loss. To make sure no single mistake, no one bad company, no one rough year wipes you out. Diversification gives you staying power. Rule 4. Costs matter more than you think. Way more. This one isn't sexy. Nobody gets excited talking about expense ratios. But it's one of the biggest levers you control. Let me show you the math. Say you have $100,000 to invest at age 35. You expect a 7% average annual return over 30 years until retirement. If you pay 1% and annual fees come in many actively managed funds, your money grows to about $575,000. Now, switch to a low-cost index fund with just a 0.05% fee. Same return assumption, same time frame, your money grows to over $740,000. That's a $165,000 difference. Real money. Vacation homes, college tuition, years of retirement gone to fees. And it gets worse with frequent trading. Commissions, bid-ask spreads, short-term capital gains taxes, they compound against you. Studies show retail investors who trade often underperform buy-and-hold investors by 2 to 4% per year on average. We've spent decades driving costs down. When we launched iShares ETFs, we competed against mutual funds charging 1 to 2%. We brought fees to 0.2%, then 0.1%, and now many core funds are at 0.03%, 3 basis points, practically free. Your action step: look at your accounts today. Check the expense ratios. If you're repaying more than 0.2 or 0.3% on broad market funds, switch. It takes minutes online and can add hundreds of thousands to your lifetime wealth. Rule 5, the one that ties everything together. Stay humble and keep learning. Managing trillions. I still spend at least an hour every single day reading market reports, economic research, company filings, new technologies. I'm still a student. Why? Because the world changes. What worked yesterday might not work tomorrow. New opportunities emerge. Risks you never saw coming appear. I've been wrong plenty. Early on, I was skeptical about certain technologies. I've had to adapt, change my views, and learn fast. The moment you think you've figured it all out, tour in trouble. Cultivate curiosity, read widely, listen to people who disagree with you, admit mistakes quickly, stay open to new ideas, sustainable implications, sustainable infrastructure, demographic shifts. We're in the middle of massive change right now. Artificial intelligence is reshaping productivity. Energy transitions are creating new infrastructure needs. Tokenization could transform how assets are owned and traded. If you stop learning, you get left behind. But if you stay humble, stay curious, you position yourself to capture the next wave of growth. Let me pull this all together. These 5 rules aren't complicated. Think in decades, not days. Build wealth through ownership. Protect yourself with real diversification. Minimize costs ruthlessly. And stay humble and keep learning. They've guided me through every market environment imaginable. They've helped millions of investors, individuals, families, institutions build real, lasting wealth. Investing at its core isn't about beating the market every year or finding the next hot stock. It's about systematically participating in human progress, funding companies that solve problems, build products, create jobs, owning a piece of innovation, productivity, and growth. For over 400 years, capital markets have done something extraordinary. They've allowed ordinary people to build extraordinary wealth. Shopkeepers in 1600s Amsterdam, factory workers in post-war America, teachers, nurses, and firefighters today. That opportunity is bigger now than ever. Costs are lower. Access is broader. New asset classes are opening up. But it only works if you follow proven principles, if you tune out the noise, if you commit for the long haul. So here's my challenge to you. Take one step today. Open a brokerage account if you haven't. Set up automatic monthly investments into low-cost index funds. Start small. $50, $100, whatever you can. But start. Think about your future self 10, 20, 30 years from now. The decisions you make today compound into the life you'll live then. You don't need to be perfect. You don't need to time the market. You just need to begin. Stay disciplined and trust the process. I've seen it work for decades. I'm more optimistic about the future of investing than ever. Your wealth-building journey starts with one decision. Make it today. If this video gave you clarity on how to build real long-term wealth, hit the like button. It helps more people find this content. Subscribe and turn on notifications for more no-nonsense investing education. And drop a comment, which rule resonated most with you. What topic should I cover next? Dividends, retirement accounts, private markets? I read them all. And thanks for watching. go on your future.